Well, welcome to the homework help for this week. It is Wednesday, so let's take a look at the homework, or also known as the learning activity, for this week in Module 5. So we've got one question. This is in Chapter 13 on capital structure. Again, I'm not going to help you with the questions because those are pretty much the easy pickings. Where you're just doing a little bit of the research within the reading of the text should be more than enough to answer 13, which is talking about the typical components included when estimating a firm's corporate cost of capital. But we do have the problems, the kind of the more math-oriented problems, which again I know cause anxiety for all of you. So let's take a look at 13.4, which we are looking at what is the optimal capital structure, and it is a cost of capital kind of question in disguise. And then we are also going to be looking at we just have one problem, only one problem from chapter 14, which we have the 14.2, and that's where we're looking at internal rate of return and a net present value kind of combination question. All right, well, let's go to the magic blackboard. I will try to help kind of give you a little bit of direction on these, and hopefully they're not too difficult. But as I've mentioned before, hopefully you've watched the lectures because I try to lecture on what I know certain topics that might be presented within any kind of assignments that you have. But let's go jump to the blackboard and kind of do a little bit of lead through on some of these questions for you.
Okay, so for 13.4, there is a nice hint given in the textbook on what you have to do. You're really looking, you're given this grid here of the percentage of debt within their capital structure. We have, I guess, the one, I would say, little trick is the after-tax cost of debt is given to you. It's actually a good little trick because it will save you some steps. And then we have the cost of equity in there. So again, the nice hint that's given to you within the textbook, it says, calculate the cost of capital for each structure. So you're going to go through each one of these and calculate the corporate cost of capital, or the WACC that we referred to in the weighted average cost of capital that we referred to in the lecture. So you'll make sure you've definitely watched that lecture. Now, just as again, kind of a lead into this question, you're going to be using that formula, and I'm going to abbreviate a little bit for time's sake here, but we've got that corporate cost of capital equals the weighted debt, that weighted average of the debt, which is basically this column here, the percentage of debt within that capital structure that you have. And then that is going to be multiplied times the cost of the debt. I'll just say that cost of the debt multiplied times 1 minus the tax rate, whatever that particular tax rate is for the organization, plus, and remember that this was the debt side of your capital structure, and now what you want to work on is the equity side of this corporate cost of capital. A little bit easier because you only have to do with the weighted average, that weighted percentage of equity, multiplied times the cost of that equity, okay? And that cost of that equity, and again, these are just given right there. There's the cost of equity, and there is I guess here is your hint. The hint is this. Remember, and in the lecture, we talked about what this part of the formula is, right here, this part, okay? That part is basically calculating your after-tax cost of debt. So you've already been given that number. So it's nice and convenient and given to you. All right, so you don't have to plug this in. This has already been calculated. So you're gonna, and I'll set up one of them for you. So what you're gonna do, I'll pick on one, not the 0, because that's the 0 is a little weird because it's a 0. Let's pick on this one. So you're gonna be doing, for example, on the first one, the weighted percent is 20%. Okay, times, well, look at that. It already gave it to me. I already know the after-tax cost of debt. Be careful on writing your percentages. The math actually works. I don't want to confuse you too much. The math actually works if you don't convert your percentages into decimal form. I guess if you're just going to do it that way, be consistent. Just kind of the way I've always done it, as I've tried to, in most cases, try to just convert it to a decimal, and then bring it back to a percentage form at the end. So that's what I'm doing here, guys. When you see me writing this, 0.20 is 20%. Remember, these are all percentages listed down through here, as these are also percentages listed all down through here. Okay, so enough of that. So all I need to do is I'm going to plug in my guess where I started before I went on that little soapbox is you want to make sure you write that as 0.066, which is the same as 6.66%. And right there, boom, you're done. That is the debt side, okay, because this has been already done for you. They've already calculated that for you in air quotes that you can't see right now. But now let's do the equity side. Again, that's pretty easy. We know the percentage of debt, little subtraction, right? So if you got 20% in debt, you're going to have 80% in equity times the cost of equity. In this case, we're using that number there. So that's 0.17, okay? And that's going to equal your corporate cost of capital. Make sure you do that for all of them, okay? Show your work on this, however you want to do it. In Word, probably might be the best. If you're doing, again, I'm more than happy to accept JPEGs or PDFs. If you want to write it on note paper or write it on paper and then scan it and turn it into a PDF, that's great too. However you want to do it, but please show your work. I am going to be looking for the application of the formula in here. And then once you've done that, once you've figured out your corporate cost of capital for each one of these given scenarios, which one is the best? Which one is optimal? Okay? All right, so that concludes homework help on 13.4. Let's move on to chapter 14. Okay, in 14.2, I hope you find this a very easy problem. You should be able to do it within 10 minutes or less. In this problem, it's involving two different projects, or you could think of it two different investments. We've got project A and project B. It's given you a bunch of cash flows, and I use K to denote 1,000. So if I have, and you might just as a little business thing, if you see K, it's basically denoted as 1,000. So if I have 2,000 K, that's actually 2 million. I'm lazy, I didn't want to write all the zeros, but just know that you have, that if you ever see a K in any kind of business documents, it's kind of a way of lopping off three zeros. So, but you have basically all these various cash flows that are in here for the two projects. And then the first question is asking you what is the IRR for the internal rate of return for each one of these projects. And then the second question is what is the net present value for each one of the projects. I guess the biggest hint, or two hints, don't forget in the within the question, within the narrative of the question, it gives you your upfront expenditure, and the upfront expenditure is 1.5 million. Okay, so you're going to be using that for both the IRR and NPV calculations. And again, if you've watched the lecture, you're going to save yourself a bunch of time and heartache in solving this problem by using the recommended 2 calculators that we had for IRR and net present value. You can use our old friend, the Arachnoid calculator, to do these, but it is much more difficult. You'd have to go through much more difficult. It can be done, but versus an hour of doing it through that, you again could probably get this solved in 10 minutes using the calculators that are shown. So those are my two hints for this one. Use the online calculators that I gave you. Make sure you go and check out within the lectures. I do give the URL location to those 2 calculators. I would recommend using them. And don't forget, again, to include that upfront cost in there. With the net present value question, which is which is part B, you are given the corporate cost of capital in a couple of different scenarios. You're asked in question B to net present value with a corporate cost of capital at 10%. Okay, so you're going to have to run that calculation. You're going to have to run it at 5% and at 15%. Okay, once you set it up in the calculator, which will literally take you maybe 2 to 3 minutes, then you just simply will be changing your discount rate, or AKA cost of capital, into that. So there you go. There's your homework help for this week. I think this week won't be too demanding on the homework. I was really hoping, my intent was that it wasn't too demanding, because I know you're reading 2 chapters that we have to kind of squish in the course, and this is the week in which we squish in two chapters in there. But I do hope that these are valuable questions. I think they definitely demonstrate the kind of the key topics I want you to get out of these chapters. Internal rate of return and net present value are some biggies in there. There's other ones, there's break even and a lot of other things I would like, but if we had to hone it down, these are a couple of ones that I really want you to know. Also going on with that corporate cost of capital with the last problem that we had. So hopefully you find these kind of beneficial to your understanding. All right, well, that concludes the homework help for this week, and good luck on the homework.